Every single morning, at exactly 5, Julian wakes up to the sound of an alarm. He is a senior vice president of software engineering, managing 80 engineers and earning $750,000 a year. To most, Julian is the definition of success. He has the prestigious title, the high income, and the secure career. Yet, every single month, when Julian looks at his pay stub, a quiet frustration settles in. Before a single dollar touches his bank account, the federal government takes 37%. His state government takes another 13%, and payroll taxes claim their share. By the time the dust settles, nearly half of Julian's hard-earned money has vanished before he can even buy a cup of coffee. He is trapped in the highest tax bracket, trading his precious time for highly taxed currency, running on a treadmill that never seems to slow down. Now, look across the street at Marcus. Marcus does not wake up to an alarm, nor does he report to a corporate office. He has no job title, and his tax return shows an annual income of exactly $0. To the untrained eye of an auditor, Marcus appears to be practically broke. Yet, Marcus lives in a mansion, drives a bespoke vehicle, and watches his net worth expand by millions of dollars every single year. Marcus is not a criminal, and he is not hiding his wealth in offshore accounts. Instead, Marcus has mastered a hidden legal game, a system-dense financial framework used by the ultra-wealthy to completely bypass the traditional tax system. While Julian works for money, Marcus makes his assets work for him, utilizing a highly sophisticated method known as debt recapture and asset-backed leverage. To understand how this economic chasm is possible, we must first dismantle the illusion of income. In the modern financial system, the government does not tax wealth, it taxes velocity. It taxes the transaction of money changing hands, usually from an employer to an employee. This is why the tax code is designed to heavily penalize earned income, while offering massive structural relief to those who hold static assets. Julian is a highly paid prisoner of earned income. If Julian wants to buy an asset or build his savings, he must do so using after-tax dollars. For every dollar Julian wants to spend, he must first earn $2, giving $1 to the state and keeping the other for himself. This massive cash drag prevents him from ever achieving true compounding momentum. Marcus, on the other hand, operates in a completely different financial dimension. His wealth is held within a diversified portfolio of equities, real estate, and private business structures valued at $10 million. Marcus understands a fundamental truth of the financial system, that selling an asset is a tactical defeat. If Marcus were to sell $1 million of his portfolio to fund his lifestyle, he would immediately trigger a taxable event. The federal capital gains tax of 20%, combined with the net investment income tax of 3.8% and state capital gains taxes, would instantly wipe out nearly $300,000 of his wealth. On top of that, he would lose the compounding power of that $1 million, forever halting its future growth. To avoid this financial self-sabotage, Marcus uses the primary weapon of the financial elite, the securities-backed line of credit. Instead of selling his shares, Marcus approaches a private banking institution and pledges his $10 million investment portfolio as collateral. This is a highly structured legal arrangement where the bank secures a lien against Marcus's assets without him ever losing ownership, voting rights, or dividend distributions. Because the bank has the absolute security of liquid, blue-chip assets, they can offer Marcus an incredibly flexible, low-interest line of credit with a high loan-to-value ratio. In a typical agreement, the bank will establish a loan-to-value limit of 60% on a diversified equity portfolio. This means that against his $10 million in collateral, Marcus is granted a continuous, revolving line of credit worth $6 million. This line of credit acts as a personal liquidity vault. When Marcus needs cash to buy a premium piece of real estate or to fund his annual living expenses, he does not withdraw money from a savings account, and he does not liquidate stocks. Instead, he simply writes a check against his line of credit, drawing down debt. To the average person, borrowing money to live sounds like a recipe for financial ruin. But when you analyze the system-dense math, the genius of the strategy becomes clear. Under the tax code of the United States, borrowed funds are not classified as income. When Marcus draws $100,000 from his line of credit, the Internal Revenue Service does not view this as a distribution of wealth. It is classified as a liability. Because it is a liability, it is completely tax-free. Marcus can spend $100,000 and pay 0% in federal tax, 0% in state tax, and 0% in capital gains tax. But how does Marcus handle the cost of the debt? This is where the concept of interest rate arbitrage comes into play. The private bank charges Marcus an interest rate pegged to the secured overnight financing rate, plus a minor bank spread of 1.5%. Let us assume the total interest rate on his line of credit is 5% per year. Simultaneously, Marcus's $10 million portfolio of diversified equities, compounding safely in the market, grows at an historical average rate of 8% per year. This creates a highly lucrative 3% positive spread. While Marcus is paying $50,000 in interest on a $1 million loan, his underlying portfolio has grown by $800,000. His assets are growing faster than his liabilities, meaning his net worth is actively expanding, even while he is borrowing money to fund his life. The interest payment itself is not a loss, but a strategic expense, and in many cases, if structured through a commercial entity, that interest can be written off against other income, further lowering his structural tax burden. This is the modern alchemy of the financial system, a continuous loop of buying, borrowing, and eventually dying. By refusing to sell his assets, Marcus ensures that his portfolio compounding engine never stops. The debt he accumulates is never paid off using earned income. Instead, it is carried forward, rolled over, and strategically managed. But what happens when the market experiences a severe downturn or when interest rates shift? To survive this high-stakes game, one must understand the exact risk mitigation math and the systemic safeguards that separate the wealthy from those who lose everything. For Julian, the biggest risk is losing his job. But for Marcus, the ultimate threat is a market crash. If Marcus's $10 million portfolio drops by 40% during a financial crisis, his collateral shrinks to $6 million. This triggers a maintenance call, where the bank demands he immediately deposit cash or liquidate assets. To insulate himself, Marcus never borrows up to his maximum. He establishes a strict internal limit of 15%. By only borrowing $1,500,000, Marcus creates a massive buffer. The market must decline by over 75% before the bank initiates a maintenance call, allowing his system to survive the most extreme economic storms. But surviving the storm is only half the equation, because a line of credit is not free capital. Every month, the private bank generates an interest statement. For most, the thought of carrying a multi-million-dollar debt balance, with compounding monthly interest, is a source of intense anxiety. They wonder, how does Marcus pay the interest if he has no earned income and refuses to sell his stocks? If he were forced to sell assets to pay the bank, his entire system would collapse, triggering the exact same capital gains tax he is trying to escape. To solve this, Marcus utilizes a critical, system-dense mechanic known as interest capitalization. When Marcus establishes his line of credit, he executes a specialized authorization with the lender. Instead of making physical, out-of-pocket interest payments, the bank simply adds the accrued interest directly to the outstanding principal balance of the loan. The debt rolls up, compounding quietly in the background, secured by the growing pool of collateral. Let us look at the raw mathematical truth of this frictionless engine. Marcus begins with a $10 million portfolio and draws a tax-free loan of $100,000 at 5% interest. At the end of year one, his outstanding debt balance has grown to $105,000. Marcus has not paid a single cent of cash to service this debt. Meanwhile, his $10 million portfolio, compounding at an average rate of 8%, has grown to $10,800,000. When we calculate Marcus's net worth at the end of the year, we subtract his liabilities from his assets. $10,800,000 in assets, minus $105,000 in debt, leaves Marcus with a net worth of $9,695,000. In a single year, Marcus has spent $100,000 completely tax-free, yet his net worth has grown by nearly $700,000. His debt-to-asset ratio has actually decreased, making his position safer than it was 12 months prior. Marcus has successfully recaptured his debt, turning a liability into a highly efficient engine of untaxed wealth. Contrast this frictionless velocity of capital with the structural friction that Julian faces every day. Julian believes he is playing a smart, conservative game. Every month, after paying his massive income taxes, Julian takes his remaining cash and buys diversified index funds inside a standard, taxable brokerage account. Julian is seeking financial freedom, but he is entirely blind to a silent killer known as tax drag. In a taxable brokerage account, Julian does not control when taxes are triggered. Every year, the index funds and mutual funds Julian owns must rebalance their underlying holdings. When a fund manager sells a stock to rebalance the portfolio, that transaction triggers a capital gain. Under the Internal Revenue Code, these capital gains cannot be retained by the fund. They must be distributed to the shareholders. At the end of every year, Julian receives a Form 1099 DIV, indicating his share of these capital gains and dividends. It does not matter if Julian automatically reinvested every single penny back into the fund and never touched the cash. The Internal Revenue Service treats these phantom distributions as realized taxable income. Because Julian is in the highest tax bracket, his dividends and capital gains are hit with a combined federal and state tax rate of nearly 30%. This means that every single year, Julian must withdraw cash from his active W-2 salary just to pay the taxes on a portfolio he did not even liquidate. This tax drag acts as a silent parasite, bleeding his portfolio of its compounding momentum. Over a 30-year investment horizon, a mere 2% annual tax drag can erase up to 40% of Julian's total potential wealth. Julian is running uphill, carrying the dead weight of a tax code designed to extract wealth from individuals. Marcus, however, avoids this trap by changing the very nature of how his assets are owned. Marcus does not hold his $10 million portfolio in his personal name. Instead, he utilizes a multi-tiered legal architecture, routing his assets through Aegis Holding Company, a specialized corporate entity registered in Wyoming. By holding his assets within a corporate entity, Marcus unlocks a completely different section of the tax code. Under Section 243, corporations are entitled to a powerful deduction known as the dividends received deduction. The federal government established this rule to prevent triple taxation, where corporate profits are taxed at multiple levels before reaching the individual. Under this system-dense rule, if Aegis Holding Company receives a dividend distribution from a domestic corporation in which it owns stock, it is permitted to deduct 50% of that dividend income from its taxable earnings. If Marcus's corporate entity holds shares in large, blue-chip domestic companies, half of the incoming dividend cash flow is instantly shielded from tax. This slashes the effective corporate tax rate on those dividends from 21% to a mere 10.5%. Furthermore, when Aegis Holding Company services the interest on Marcus's line of credit, that interest is not viewed as a personal expense. Under Section 163, because the line of credit is held by a commercial entity and used to fund business operations, the interest paid is classified as business interest. This makes the interest fully deductible against the holding company's corporate revenue. Marcus has constructed a highly efficient, self-sustaining loop. The incoming dividends, taxed at a heavily discounted corporate rate, flow into the holding company. These dividends are then offset by the deductible interest payments on the line of credit. The remaining capital is reinvested, free from personal income tax, and completely insulated from the heavy tax burden that Julian faces. The holding company acts as a protective shield, allowing Marcus's wealth to compound in a frictionless environment. But the corporate holding company is only the first layer of this defensive architecture. To truly protect his legacy and ensure his wealth can transition to the next generation without ever triggering a single dollar in estate or inheritance taxes, Marcus must integrate his corporate holdings with an even more powerful legal entity, the irrevocable trust. An irrevocable trust is the ultimate wealth fortress, acting as a separate legal entity that exists completely outside Marcus's personal estate. When Marcus transfers the ownership of Aegis Holding Company into his irrevocable family trust, he is no longer the legal owner of those assets. He owns nothing, yet he controls everything. Because Marcus does not personally own the holding company, those assets are completely insulated from personal lawsuits, creditors, and most importantly, the federal estate tax. Under the current tax code, any assets held inside a properly structured irrevocable trust bypass the estate tax entirely, allowing millions of dollars to transition to his heirs without triggering a 40% tax rate. But the true genius of the buy, borrow, die strategy is realized during the final, inevitable step. To understand this masterclass in portfolio math, we must analyze Section 1014 of the Internal Revenue Code. This single section containing the step-up in basis rule is the magic key that unlocks generational wealth, completely erasing a lifetime of accumulated debt and deferred taxes. Let us look at the mathematics of this final transition. Over his lifetime, Marcus has watched his $10 million portfolio grow from an initial investment of just $2 million. If Marcus had sold these stocks while he was alive, he would have been forced to pay capital gains taxes on $8 million of appreciation, resulting in a tax bill of over $2 million. Instead, Marcus chose to borrow $1,500,000 against his portfolio to live his life, leaving the underlying shares untouched. When Marcus dies, the legal ownership of his assets does not trigger a taxable sale. Instead, Section 1014 dictates that the tax basis of his assets is instantly stepped up to the fair market value on the exact day of his death. The original cost basis of $2 million is legally erased. It vanishes into thin air. The new tax basis of the portfolio is reset to exactly $10 million. Marcus's heirs, operating through the irrevocable family trust, now inherit a $10 million portfolio with a $10 million tax basis. They are also faced with the outstanding $1,500,000 line of credit that Marcus used to fund his life. To pay off the private bank, the heirs instruct the trustee to sell $1,500,000 of the inherited stock. Because the tax basis of the stock was stepped up to $10 million, the sale of $1,500,000 triggers exactly $0 in capital gains. The heirs pay $0 federal tax, $0 state tax, and $0 capital gains tax on the liquidation. They use the cash to pay off the bank, closing the line of credit permanently. The math is astonishing. Marcus spent $1,500,000 tax-free during his lifetime, and his heirs inherited the remaining $8,500,000 in assets completely free of capital gains tax. The tax liability on $8 million of stock appreciation has been legally, permanently extinguished. The debt was used to capture the wealth, and the tax code was used to recapture the debt. Now, compare this generational transition to the financial wreckage that awaits Julian's family. Julian spent his entire life working 80 hours a week, accumulating a substantial nest egg in his traditional 401k and individual retirement accounts. Julian believed that by utilizing these government-sponsored tax-deferred vehicles, he was securing his family's future. He was wrong. Under the Setting Every Community Up for Retirement Enhancement Act, commonly known as the Secure Act, the rules of inheritance have been brutally rewritten. When Julian dies, his children do not receive a step-up in basis on his 401k or individual retirement accounts. Instead, the law forces them into a highly penalizing mechanism known as the 10-year rule. Under the 10-year rule, Julian's heirs are legally required to withdraw every single dollar from the inherited 401k within 10 years of his death. Because these tax-deferred accounts were built with pre-tax dollars, every single withdrawal is treated as ordinary income. Julian's children are already in their peak earning years, established in their own careers. When they are forced to liquidate hundreds of thousands of dollars annually from Julian's inherited accounts, that extra income pushes them into the highest federal and state tax brackets. Nearly half of Julian's lifetime of labor is instantly confiscated by the government, leaving his children to inherit a fraction of his wealth. Julian worked for money, paid maximum taxes on his salary, paid phantom taxes on his investments, and left his family a heavily taxed retirement account that triggers a forced liquidation. Marcus worked for assets, paid $0 income taxes, borrowed tax-free money, stepped up his basis, and passed his wealth to the next generation without a single penny of friction. But the buy, borrow, die strategy is only one component of the shadow financial system. To fully leverage this loop, the ultra-wealthy do not just borrow against stock portfolios. They utilize private equity, commercial real estate, and sophisticated entity structures that allow them to manufacture paper losses to offset active income. To truly understand how this works, we must examine the hidden world of cost segregation and the legal loophole known as the real estate professional status. To see this systemic disparity in action, we must look at how Julian and Marcus approach physical assets like real estate. Julian, feeling the pressure of his heavy tax burden, decides to buy a residential rental property for $1 million. The property generates $20,000 in net taxable paper losses through standard, linear depreciation. Julian expects to use this $20,000 loss to offset his $750,000 software salary, directly lowering his tax bill. But when he meets with his certified public accountant, Julian receives a harsh lesson in tax code mechanics. Under Section 469 of the Internal Revenue Code, the federal government establishes a brutal barrier known as the Passive Activity Loss Limitation Rules. Under Section 469, all rental real estate activities are classified as passive by default, regardless of how much active labor an individual puts into them. This means that passive losses can only be used to offset passive income, which represents income generated from other passive activities. Since Julian's software engineering salary is classified as active, earned income, his $20,000 rental loss cannot touch it. The loss is legally frozen or suspended and carried forward to future tax years. Julian has spent his hard-earned cash to acquire an asset, yet he receives zero immediate tax relief. He remains fully exposed to his 50% marginal tax bracket. Marcus, however, operates with a completely different playbook. Marcus owns several commercial real estate properties as part of his diversified portfolio. Unlike Julian, Marcus completely bypasses the passive activity loss limitations of Section 469. He does this by qualifying for a highly coveted tax designation known as the real estate professional status. To meet the strict statutory requirements of this status, Marcus must satisfy two rigorous tests. First, he must perform more than 750 hours of service in real property trades or businesses during the taxable year. Second, those 750 hours must constitute more than 50% of his total active working hours for the entire year. Because Marcus has no active W-2 job and spends his time actively managing and acquiring his properties, he easily meets both criteria. The moment Marcus is legally classified as a real estate professional, the statutory presumption of passivity is shattered. His real estate activities are reclassified as active. Consequently, any paper losses generated by his real estate portfolio are no longer restricted. They are converted into active losses, which can be used to offset any form of income, including corporate dividends, interest, or active business profits flowing from Aegis Holding Company. To manufacture these massive active losses, Marcus utilizes an advanced engineering and accounting process known as a cost segregation study. When Marcus purchases a commercial retail plaza for $5 million, standard accounting rules dictate that he must depreciate the physical building structure over a tedious 39-year period. This results in a relatively small annual depreciation deduction of roughly $128,000. But Marcus does not accept this slow recovery of capital. He hires a specialized engineering firm to perform a complete cost segregation analysis of the property. The engineers physically and structurally deconstruct the $5 million plaza into separate, distinct asset classes. They identify personal property, such as specialty lighting, carpeting, and security systems, which qualify as 5-year property under the tax code. They also identify land improvements, such as paved parking lots, concrete walkways, and landscaping, which qualify as 15-year property. The core structural envelope of the building remains classified as 39-year property. The study concludes that out of the $5 million purchase price, $1,500,000 actually belongs to these shorter-lived 5- and 15-year asset classes. With the cost segregation study complete, Marcus unleashes the ultimate weapon of accelerated depreciation, Section 168K. Under the permanently reinstated rules of the One Big Beautiful Bill Act, bonus depreciation is set at a full 100% for qualified property. Instead of waiting 39 years, or even 5 to 15 years to recover his capital, Marcus is legally permitted to write off the entire 100% of that $1,500,000 in the very first year the retail plaza is placed in service. This creates an immediate, staggering paper loss of $1,500,000 on Marcus's tax return. Because Marcus has real estate professional status, this $1,500,000 paper loss is classified as active. It completely wipes out his taxable income from other business entities. Yet, this loss exists only on paper. In reality, the commercial retail plaza is highly profitable, generating steady monthly cash flow from its tenants. Marcus is collecting real cash in his bank account, while presenting a massive, legal paper loss to the Internal Revenue Service. He is building real wealth while paying $0 in income tax. As the years pass, the retail plaza appreciates in value, growing from $5 million to $7 million. Marcus wants to access this new equity to expand his operations, but selling the property would trigger massive capital gains and depreciation recapture taxes. To extract his equity completely tax-free, Marcus executes a cash-out refinance. He approaches a commercial lender who agrees to provide a new commercial mortgage at a 70% loan-to-value ratio, based on the new $7 million valuation. The bank writes Marcus a check for $4,900,000. Marcus uses $3 million of the new loan to pay off his existing debt, leaving him with $1,900,000 of cash in hand. Because this cash is structured as debt from a refinance, it is not a realization event. It is completely tax-free. Marcus pays zero capital gains tax, and the interest on the new mortgage is fully deductible as a business expense. He has successfully extracted nearly $2 million of untaxed wealth to buy his next asset, while Julian is still struggling to pay off the taxes on his W-2 salary. The loop is complete, and the wealth compounding continues, completely unchecked by the tax system. This parallel economic universe, where debt is transformed into tax-free liquidity, is not an accident. It is the logical consequence of a global monetary system built on debt and fiat currency. When Julian looks at Marcus, he often feels a sense of deep injustice. He wonders how a system can allow one individual to pay millions of dollars in taxes on a hard-earned salary, while another individual, living in far greater luxury, pays absolutely nothing. But to understand this disparity, we must look past the superficial mechanics of the tax code and examine the underlying structure of currency creation itself. The modern financial system is designed to reward the accumulation of assets and penalize the accumulation of cash. Since the abandonment of the gold standard, central banks have expanded the money supply at an unprecedented rate. When the Federal Reserve prints trillions of dollars, they do not distribute it evenly to the population. Instead, the newly created currency enters the economy through the banking system, in the form of low-interest commercial debt. This is known as the Cantillon effect, a financial principle stating that those closest to the source of money creation benefit the most, while those furthest away are systematically impoverished. Because Marcus has direct access to the private banking system and institutional lines of credit, he stands directly at the mouth of this monetary river. As this newly printed currency floods the market, it does not immediately drive up the price of consumer goods like food or fuel. Instead, it flows directly into financial assets, causing the value of equities, commercial real estate, and private businesses to escalate rapidly. For Marcus, this asset inflation is a powerful, continuous tailwind. His $10 million portfolio and his commercial retail plaza grow larger and more valuable every day, driven by the expansion of the money supply. This growth is not a reflection of increased productivity, but a reflection of a depreciating currency. His assets are simply acting as a financial sponge, absorbing the newly printed money. For Julian, however, this currency expansion is a catastrophic headwind. Julian is paid in fiat dollars, a currency that is actively losing purchasing power at a rate of several percent every single year. Even if Julian receives a raise at his corporate job, that raise is immediately eroded by inflation and hit with his 50% marginal tax bracket. Julian is saving depreciating cash in a high-yield savings account, hoping to build a nest egg. But the interest he earns on his savings is fully taxable as ordinary income and is heavily outpaced by the real-world inflation of hard assets. Julian is running on a treadmill that is accelerating backward, paying a hidden inflation tax that no politician ever votes on. But the mechanics of currency debasement reveal an even deeper secret, one that Marcus exploits with absolute precision. In an inflationary environment, debt is a depreciating liability. When Marcus borrows $1,500,000 against his portfolio, that loan is denominated in nominal fiat dollars. As the purchasing power of the dollar declines, the real-world value of Marcus's debt also shrinks. Simultaneously, the value of the assets backing that debt is expanding. Marcus is essentially shorting the dollar, borrowing a currency that is guaranteed to lose value, to acquire and hold assets that are guaranteed to appreciate. He is paying back his loans with cheaper, debased currency, letting inflation do the heavy lifting of servicing his liabilities. This is the core paradigm shift that separates the wage earner from the asset owner. Julian believes that wealth is a product of labor. He believes that by working harder, managing more engineers, and securing a higher salary, he can buy his way into financial independence. But Julian is trading a finite resource, his personal time, for a currency of infinite supply. The math of this transaction is fundamentally flawed. Time cannot be compounded, and fiat currency cannot retain value. By trading time for cash, Julian is playing a game where the rules are structurally rigged against his success. Marcus, conversely, understands that true wealth is not about the size of a paycheck, but about the structural ownership of productive systems. Marcus does not trade his time for currency. Instead, Marcus uses his time to construct and acquire self-sustaining corporate and asset-backed loops. He wraps his assets in Wyoming holding companies, shields his family with Delaware irrevocable trusts, leverages tax-free debt structures like securities-backed lines of credit, and wipes out his remaining liabilities using cost segregation and 100% bonus depreciation. Marcus does not fight the rules of the financial system. He aligns his behavior with them. This creates two completely separate Americas. The first America, populated by citizens like Julian, is the land of income, active labor, high taxes, and currency depreciation. The second America, inhabited by citizens like Marcus, is the land of assets, structures, debt leverage, and wealth preservation. One group operates as the fuel of the economic machine, while the other group operates as the operators of the machine. The divide between these two classes is not growing because of hard work, but because of a fundamental asymmetry in financial education. Many observers argue that the loopholes utilized by the ultra-wealthy are unethical or should be outlawed. But from an analytical perspective, these mechanisms are not mistakes. They are the deliberate design of the economic framework. The tax code is not just a tool for collecting revenue. It is a highly structured guide written by the government to direct capital. The government wants capital to flow into productive enterprises, into infrastructure, into corporate expansion, and into housing. Because the state cannot efficiently manage these sectors, they offer massive financial incentives, in the form of tax exemptions, to private citizens willing to take the risk of deploying capital. Julian's high tax rate is the penalty he pays for consuming capital rather than deploying it. By receiving a salary and spending it on lifestyle, Julian is failing to direct capital toward the areas the government prioritizes. Marcus's 0% tax rate is the reward he receives for acting as a private conduit for the state's economic goals. By building businesses, investing in equities, and developing commercial real estate, Marcus is doing the work the government desires, and the tax code compensates him accordingly. The choice between the path of Julian and the path of Marcus is not a matter of intelligence or luck. It is a choice of structure. The financial system is a dense, complex machine, operating on mathematical rules that remain invisible to those who refuse to look. One can spend a lifetime working within the engine, feeling the heat of the friction, or one can step back, analyze the blueprint, and construct a frictionless loop of their own. The machine will continue to run, printing currency, inflating assets, and taxing labor. The only question that remains is which side of the equation you choose to occupy.